Rohr here with an early concise highlight on Friday, August 28th, 2015. It is currently 7:45 a.m. We're coming to you a bit later than usual because we wanted to see the U.S. personal income and spending figures prior to providing this report, and it is a concise highlight today because we're only actually providing a video analysis on the S&P 500. All the rest is much the same as yesterday's global view, trend view video, extensive discussion of most of the markets. Also, before we go any further, keep in mind Monday is the UK late summer bank holiday. London is closed up tight. And what we have here in the short-term view of the S&P 500 is a market that is currently off 13 early today after the late surge yesterday. So it's back down to 1976. Now, of course, this is very important in the scheme of last week's close being 1971.40 and the market gapping back up yesterday, but you'll notice it closed off the gap higher. That was very important, that late day dip, even though it rebounded very nicely after that up to a new high, because by leaving a low early at 1958 versus Monday's high at 1950, there was an actual island bottom created. This trading Monday through Wednesday was completely separated from the higher activity prior to the gap lower and subsequent gap up, and that can signal a more powerful bottom. While the market did bottom certainly and held with only minor slippage back below the 50 area, closing off the outright gap is an important sign not to look for maybe too much more explosive upside activity. Now, the higher resistances remain with not much at 2,000. It's a psychological area, but it hasn't basically been important since it got overrun in both directions starting late last year. And the bigger resistance can be up at the weekly chart down break we'll view shortly. That's up in the 2015 area, so it correlates pretty well with this two-thirds retracement, Fibonacci two-thirds retracement of the entire break from the all-time high made back in May at 21.25 down to the trading low on Monday at 18.31. And extended resistance above that is back up into the 2040 to 36 area that has been so important that we will revisit as well. But for right now, what we have is a market that by backing off towards 70 is going to see, much like yesterday where it filled out and filled in the gap but held, whether it can hold 70, in other words, keep itself out over the top of the gap late week, that would probably feed some further strength. Now, the other reason that 70 is going to be relatively important is that on the aggressive upswing after the market got punished again late Tuesday, it held on Wednesday morning into lunchtime on the pressure back below the 1900 area. The 1900 was this up break. The market again failed from Tuesday, tried to stay bad below again on Wednesday and got good again. So that's the importance of that area. But the key now is that this aggressive upward channel, it was very interesting. This was in place before this market dipped late yesterday, that it held the dip using the topping activity as our reference slope of the trend, that it held the dip right into idealized channel support here down around 1946. Well, as we get out a bit later today, you get out into mid-morning, that's up to 1970. And again, we're already trading down around 76 in overnight trade. By the time we get a bit later in the day, the market's up around the trading high here at 1989. That would be into lunchtime. By late this afternoon, this market is actually trading, the channel support's actually up to 2007. So whether or not the market the bears can at least break this channel, and they'd still have to put the market back below 1970 at least overall to really get it to look bad again, but whether they can even break this channel to begin to erode the current upside momentum is going to be very important as we head out later today. And that pretty much does it for the short-term view of the S&P 500.